Well, you've had some great calls, Ben. Congratulations.
Dude, I was pretty garbage from like May until I had a couple good longs, but then I had a couple bad longs in the Q3. But yeah, it was a good start to the year, Charlie. And then we had a rough period of fake blow off top. I'll tell you, who's the worst? Kevin's a good blow off top player. I can tell. He rerides those things. You know who's the worst blow off top player in history?
Who?
Me.
What?
Sucked in 2021, and I suck now. Or I sucked. Now I'm back. Now things are good again. But man, I'm not a good blow off top player.
I had a good year until September, and then started to suffer in October and early November. But I think I'm going to get paid for my patience. Is what I was doing. I really transformed my whole portfolio in September, October, away from the metals and towards energy. And then I started shorting the financials, and that was painful, shorting the financials. I think I'm going to get paid.
I mean, I got smoked. I started shorting the financials in May. I mean, to be fair, Charlie, I started shorting Wells Fargo like $69, and you warned me, you're like, look, they're going to announce this buyback. You should wait. And that was great advice that I didn't listen to. And now it's like 81. We're going to come back, but like, there's a lot of shorts in the last 6 months I've done where the money came back, but I didn't make any money. Like, I'll give you an example. I shorted NVIDIA at 182 like in September or early October. And then it did that blow off top move, like 211. And I was short, it doesn't matter how much I was short because we're in public, but like short enough that it was like real money. And the next day I'm like, what are we doing here? But then I was like, I'm not covering this. And then right like a week ago or whatever, that maybe 2 weeks ago when we had that ugly Friday, I was like, you know what? I'm getting out of here. I've seen enough. I got my money back, but I didn't make any money, but I got it back. And like there was like a couple of those where it was like, you know what? I've been on the wrong side of the trade for a while, and like now I'm back to even. I'm just gonna call it. I'm gonna bend the knee. I'm out of here.
I've actually traded NVIDIA well. I literally bought it 2 days before they report, so at 180 and change. When they reported it skyrocketed, I sold out my position 193. So it just scalping point, and then went short it. And so for me, I've enjoyed it.
I'm having a great time right now. I'm listening to the podcast where they've seen the NVIDIA results and they saw the first reaction, but they don't have the reversal. They, in there, they haven't seen it yet because that's when they put the podcast up, and it's see Michael Brey. You stick that in your depreciation, and thank you, Jensen, for setting everybody right. And making the trade right. And my whole thing is, if that number and that call can't make the stock go up, I don't know what the hell's going to. What are they going to do?
Well, so my view is this. I this is now my strong view, which is basically that there's a lot of people who think they're entitled to making outsized money, way higher percentage gains than the economy's growing at. And that is not a sustainable situation. And in the guys like Bitcoin and NVIDIA and Saylor who treated these people well, they're like Fremen. If you guys ever seen the movie Dune, they're like true believers in Paul Atreides. And like, they don't actually operate on logic. They post dumb shit like Saylor's been, like hodl. Like they say these marketing messages. It's fucking insane. Sorry for my language. But like, that's how I feel. We're talking about people.
My mom watches this show.
We're talking about people who need to be absolutely crushed, just like the day traders of 2000, and then they can become real estate flippers when the housing market gets going again. And my rocket's at $60, Charlie. All right, let's start the show.
All right, let's start the show.
I thought we already had, but you're heavily caffeinated today. I can tell.
Well, we'll talk about it. All right, I am.
Ben and I are having some good days today, so we're happy guys.
Well, Kevin, let me start it. This is Wall Street Beats. I am Benjamin Brey. This is my buddy Kevin Baker and my other buddy Charlie Peabody, and we are here to talk about what's going on in the market. It's been super exciting times, and we're having a lot of fun. If you follow me on Twitter, you know that I've been just having a blast with this lately, being a little silly. But let's talk about
That's
Charlie.
capital misallocation for those keeping score at home, if you don't know.
No, but no, it's my name. It's Ben Brey. At Ben Brey
Okay.
is my actual
Okay.
handle. My like whatever you put the title or whatever is capital misallocation, and my Substack is also capital misallocation, which I thought was a funny name also, because I
I'm
like
just
to not
giving
take
you a
myself
blatant
seriously.
plug. Blatant plug. I'm helping I'm giving you an alley-oop.
Thanks, buddy. I'll dunk it for you. All right. So my buddy Charlie here had a really good insight a couple weeks ago, and he said to me, "Hey Ben, I don't think this market can roll unless the banks roll and Nvidia to some extent. Like, and I think that's right. Like, I think Nvidia and JP Morgan to just encompass it, and I'm sure Charlie can elaborate on it like more, but like those two stocks are the generals of this market. And they're down a little bit today, which is interesting. So Charlie, tell me why you thought that and where you think we could, you know, you don't have to talk about Nvidia because you're a bank analyst, but like let's talk about the banks. Where could JP Morgan and Goldman Sachs and these guys and your you know great call on Citi, where could they get tripped up where we get a re-rating down on these guys?
Absolutely, and let's come back to Citi at the end of the show because there's a separate issue there with the transition with their CFO. But yeah, so I started turning bearish in September, started shorting the financials in October, and it was painful at first. But what I was really shorting was the large cap banks, the capital markets bank stocks, and I was shorting them for a couple reasons. They had a blowout third quarter in capital markets, which was well televised, and you know I thought that would be peak if you annualize that third quarter. It was the best third quarter in history, by the way. If you annualize that, that would be close to peak revenues for 2026. And so the question was, what do you want to pay for peak revenues? And I thought we were pretty close. I mean, Ben will pay something different than I will pay versus Bakes will pay, but we were pretty close. And then I started thinking about the shutdown and what the shutdown would do to delaying some of the deal flow in terms of M&A approval, because you need the FTC to approve deals. The SEC was shut down, and so there'd be delays on IPOs and underwriting. So I thought the fourth quarter, just from the delays, would be weak. And then thirdly, typically there is a seasonal decline in trading revenues in the third quarter. In the fourth quarter versus the third quarter, and that this decline could be even greater given how strong the third quarter was. And then I started thinking about the credit side of the debt underwriting, and thinking that if we had some credit events, which I think we have had and will continue to have, we get a spread widening trade, and that would make the debt underwriting in the FIC trading cycles unattractive. So there was a culmination of things. I've written about all of these. They're all posted on Wall Street Beat, so you can go back and read them. Just read the last month or so of my writings, and you'll see all my commentary. But the bottom line is that I thought that fee income would prove disappointing in the fourth quarter. So Jen, if you can put up the first slide. I just want to set the table by giving you some general observations. This is the fourth quarter expectations. You can see on the left-hand side my expectations, and on the right, the column just to the right of that is the street expectations. The salmon-colored column all the way to the right. I chose salmon because I know it reflects well on Bakes. He likes that color.
It's very soothing, very soothing.
But you can see that on the very right-hand column is the year-over-year change in the dynamics, and revenues are going to be up a strong 7.3% year-over-year. But the bigger driver of revenues is fee income, and that's where I think the disappointments can come in, because that fee income is driven by capital markets revenues and wealth management revenues. So let's talk a little bit about the capital markets. Jen, if you can go to the next slide. This is the fourth quarter expectations for capital markets. The top is total capital markets, which is really just trading plus investment banking. The middle are the trading revenues, and the bottom are the investment banking revenues. Now, typically, trading revenues have a seasonal decline from third quarter to fourth quarter. of about 15%. And you can see the market right now is projecting about a 14.6% decline quarter over quarter for trading revenues. So they're building in that, quarter over quarter from third to fourth for this group of five banks, trading banks. So that's in line with the seasonals. But if we've had the macro funds and the hedge funds exiting because they want to preserve their year, it could be even more. And if we have some dislocative events like we've had in Bitcoin, it could be even more. And Citigroup actually spoke to that in their October conference call. Citigroup said, we're expecting our trading revenues to be down 15 to 20% just on the seasonals alone, just partly because the third quarter was so strong. They just didn't see a sustainability to that. So if we have any kind of dislocative trading environment, the 15 to 20% is probably going to be, conservative, and we could have a 20% plus type of decline from third to fourth quarter. So that's one area of vulnerability. The second is on the bottom chart, which is the investment banking revenues. You can see the projection is for flat to slightly down in investment banking revenues. But with the shutdown of the FTC, which approves M&A, and with the shutdown of the SEC, which approves underwriting deals, that, and then you have the holidays coming up with Thanksgiving and Christmas and Hanukkah. Things slow down on the underwriting side. And if we have a dislocated market, the appetite from the buy side is going to disappear as well. So I think investment banking could prove disappointing. So I just want to highlight, these are the expectations as of today. I think they're going to disappoint to the downside. Let's go to the next slide. So here's the other piece that's very important is wealth management. And you can see that based on the wealth management projections for the fourth quarter, which are the salmon colored columns, we're expecting about a 2% rise quarter over quarter. Now, wealth management revenues are driven by two things. One is asset appreciation, how far have the markets rallied, both on fixed income and on equity. And secondly, on transaction volumes. Although the latter is proving to be less and less important. It's mostly the asset values. Well, on September 30th, the S&P closed at 6688. As of today, we are down 2%. So prices have deflated, not inflated, which likely suggests that these wealth management revenues are going to disappoint. So the culmination of all of this is you've got trading, investment banking, and wealth management are the biggest drivers of fee income, I think are going to disappoint. Now, the question becomes, where are we going to get a sense of this? Goldman Sachs has an annual banking conference where all the major CEOs come and speak on December 8th, 9th, and 10th, I believe, but certainly the 8th and the 9th. And JP Morgan, I believe, speaks on the 9th. Wells Fargo also speaks on the 9th. JP Morgan historically has given guidance on their capital markets and wealth management revenues at that forum for the fourth quarter, and starts to give some guidance for the next year. I will tell you, I think JP Morgan is going to guide in a disappointing way. And that could be the catalyst for these stocks to roll over. Because if you think about it, if the fourth quarter capital markets income is disappointing, you go into January when they give the full year guidance for 26, and you've lost your visibility to a very important fee income component. So it also could affect 26 expectations on revenues. So I think it's going to be a very important date on December 9th when JP Morgan provides some guidance. The last thing I want to do is the next slide, and I'm hoping you can read this. If you can't, I'll try and explain it. Now I'm taking off my analyst/investor hat and putting on my trader hat. And I won't pretend to be a great trader, but when I do trade, I think in terms of price, time, and event. And what this slide tries to show is some prices on the left and then some events on the right. So let me read it to you because I don't think you can see it. The first column on the left-hand side is the closing price for 11/20 as of last night. The second column is the October lows of this year, the October lows. And then the third column is what we've dropped, what sort of drop we would be required to have to make it back to those October lows from last night's close. And that's roughly a 4% drop. So from last night's close to the October lows would be a 4% drop. The reason I'm pointing that out is all of these banks hit new highs in November. And Bakes back me up on this, but if they drop 4% from here, they will make new lows in November versus their October lows. That would represent what we call in technical language a monthly reversal. That's huge in technical terms. And I'll defer to Bakes to back me up on that. But if we get a monthly reversal, all the technicians are going to come out and say something's broken in these bank stocks. Then going back to that other column, if you can, that other chart. I just want to make some observations. Can you back up, Jen? Yeah, sorry. All right. So the right-hand chart is some observations about each of these banks, and I just want to make some technical comments. So if you start with Bank America as of today. So I'm thinking in terms of price, time, and event. Bank of America today is trading below its November 5th Investor Day low. All right. So Investor Day was just, a week or so ago, November 5th. It was a very bullish presentation. It was an all-day presentation. Everyone came out bullish and raised their estimates, raised their ratings, et cetera, on November 5th, and the stock rallied. As of today, it's trading below the low of that Investor Day. And if you look at yesterday's intraday price action, it traded up to the high of November 5th and failed. So I think that's a very important event and price action, that Bank of America could not hold its Investor Day low and failed at its Investor Day high. All right, so let's talk next about Citigroup. Citigroup is the only one of these banks that failed to make a new high in October. In November versus their October high, and that's, I think, very disappointing that it couldn't make a new high when all these other money center banks did make a new high in November versus October. Last night, Citi announced that the CFO was stepping down. I don't think that's a huge negative, but it is suggesting that this new CFO that comes in next March can set different targets, because he may not want to adopt the targets of the old CFO, and so that concerns me if he sets new targets that are not as have as much upside. All right, let's move to JP Morgan, then I'll do these next 3-4 quickly. JP Morgan is only 2.6% above its October low, so you get a 2 or 3% drop in JP Morgan, and it's on its way to a monthly reversal, which I think technically would be very, very damaging. JP Morgan is also trading at over 2 times tangible book value, which is, in our world, a very expensive stock. So I would expect JP Morgan to complete that monthly reversal. Wells Fargo, which is the next one down, would need to break its 50-day moving average to complete a monthly reversal. Not necessarily unlikely. We saw this back in April, where all these stocks did break their 50-day moving averages. The next one is Goldman Sachs. Its low on October 14th, when it reported blowout earnings. So on October 14th, Goldman Sachs reported blowout earnings. Its low that day was 742.46. It will probably, its October low was 740. So if it breaks that 740, 742 level, it will be trading below its earnings of October 14th and trading below its 50-day, its October low. Though trading below those two levels would mark a real big break in my mind. And then finally, Morgan Stanley. This is the most expensive bank stock that I follow. 15 times 26 earnings and 2.3 times tangible book of 48.64. It is also trading, only slightly above its 50-day moving average. So I think if you go back to the April correction, which happened over a week, a matter of 2 months, that we saw about a 34% drop in all of these stocks. I think that's the kind of correction we could see going into next January based on disappointing guidance on December 9th and potentially disappointing guidance in mid-January when these guys give 26 guidance. So I apologize for my long-winded, but I just thought those were all interesting data points. So I'll stop
Lots
there.
Lots of interesting observations, buddy. I will say I'm looking at the market right now.
What's the echo?
Morgan minus 150 bips.
I can hear you.
Can you hear me?
Yep.
Yeah.
Sure.
I said JP Morgan minus 150 bips. Like, that's what we wanted to see. Like, we came into this thinking, like, when is JP Morgan going to crack? And, like, that's kind of been my guidepost. I know you like to look at Goldman as well.
Yeah. Because if we have some kind of dislocation,
a little bit too.
What? If we have some kind of dislocation in the capital markets, spurred on by Bitcoin or some other event, and I think Bitcoin's sort of at the epicenter of some of the stresses right now. But if we have some kind of dislocation, the big suppliers of financing for this bull market have been Goldman Sachs, JP Morgan, and more recently Wells Fargo. And I think those three are very much at risk if we have dislocative capital markets.
Yeah, and you think about what disrupts capital markets. I've done over 1,000 capital markets deals with banks in my life. I would say that you have higher volatility, which we have. We're over 25 VIX. You have credit spreads widening, not crazy, but at 350 on the high yield CDS and 55, 50, or almost 56 actually in IG. And we have, uncertain liquidity situation and some sentiment narrative questioning. That's what gets people to say, oh, I don't know. Because if we think about CoreWeave's IPO, remember, Charlie, in the Q1, it took NVIDIA taking 25% of the book to get that deal done. And, it went on a run from there, they priced the deal at 40 and it went to, so capital markets are fickle and they can change on a dime. And then, I don't know banks as well as you do, but basically you're saying that like that can get revised down. So you could have a basically an earnings miss with rates going down, essentially, right? Like net interest income could be starting to go down and the capital markets part of it could be going down.
Absolutely. And think of why, if rates do go down, it's either because there's stress in the money markets, which is probably why Williams came out today and talked about the possibility of keeping the door open to a rate cut, or it's because credit stresses are developing. Neither of those are good for the capital markets. And one of the things that I think that is very possible that we could see in the way of headlines in the next couple of weeks, if the markets do become dislocative, is articles about hung loans. Think about all the deals that have been announced recently and the committed financing from the banking industry. I mean, Electronic Arts was a $55 billion deal. JP Morgan by itself said we'll take down $20 billion to finance that. That kind of commitment really puts you at risk in a dislocative capital markets. So I think
Kevin, do you play John Madden football? Will you be supporting that EA deal? Are you a John Madden football player? I know you're a big Pats fan.
I was an actual football player in the helmet era.
Wall Street beats through here, and they're very happy people. Pats are back. You got the new Brady. Look at these guys.
Oh, we're very much aware of that.
Look at the smiles on these guys' faces.
Yeah, and Buffalo's loss last night puts us back in the driver's seat for first place.
Yep.
So
back where you belong, right? At the top of the AFC East.
Anyways,
let's just stick
with a good Lord intended.
That's my game on the trading front here, Ben, too. So
all right, Kevin, Can you
Yes.
walk us through a couple of these charts of these banks that we've been talking about?
Well, and I'm struck by this because J.P. Morgan. This is kind of like stepping on Superman's cape, as Jim Croce would sing. And I said, okay, what are you doing, shorting, new highs here? Are you out of your mind? And I kind of use this example. I don't want the wildebeest that's in shape. I want the wildebeest that smokes and drinks and is groggy at the watering hole. And J.P. Morgan is in great shape, and so the lion's going to go after other ones, or the bear. But I don't think bears go after wildebeest. I just like saying wildebeest. So I thought this was interesting. And this, by the way, this second reversal here, and I give, if you want to see them all, I can do them, but the SPY looks like this, the S&P 500, but it's basically NVIDIA or bust. New high, this is yesterday, new high, and I think we said it offline. I said it offline. If NVIDIA can't make its stock hold up with that earnings call and press release, what the hell is going to make it happen? And so it hit a new high intraday, closed near the low. JP Morgan looks like this. This is what I'm showing right now. The SPY, frankly, all the banks look like this. They have this reversal that's going on. I'm with you with the monthly reversal. And then you have this dynamic of year end tax loss selling and guys, saying, see, I was underweight the financials. I made you money in the first 10 months of the year. I'm sure as hell not giving it back in the last 2. So I'll talk about some of the names that I came up in my work last night that I think feeds into your comments as well, Charlie.
Well, let me make a little comment real quick about the end of the year thing, because I really had an all-timer day yesterday, and I was convinced after that print that it was a gift. I told two of my partners, I said, this is a gift from God. That's what I said. I said, this is going to be one of the great fades of all time. And yesterday was one of the great fades of all time. And let me tell you something. You see a fade like that, that only happens in a bear market. That was the official announcement that the bear market has started. I knew it started a while ago. Charlie did. It's been a little bit annoying, but yesterday was the official announcement that the bear market has started. Because like Kevin said, if you can't go up on that print, there's just a deleveraging going on. And now you got guys who run books who are going to say, you know what, I'm not going to defend this to risk my bonus for the next 6 weeks. And Jay Powell's out there saying, hey, I'm a cowboy. I'm not going to cut, in December, which makes no sense other than a political thing, which we're not going to get into that discussion. But then the market's going to have to say, hey, we're going to force your hand. So I think Kevin's right. I think that there's no one who's going to be the bid. And you've seen it now 2 days in a row. You saw it on the open yesterday when we had a huge bid and it completely faded one by one by one by one. And now almost the whole board's red again. So that's a market that's not a vol collapse market like, in the spring or COVID. It's a market that's lost buyers. And now guys are selling calls against.
Hey,
think about what we're doing. We're talking about JP Morgan and NVIDIA. That's mom and apple pie. I mean, these are the highest valuations, stalwarts, CEOs that are deified, and they're going down and they're breaking levels. So, you're right. The generals just got at least wounded, and we'll see if they got shot.
Wounded, not shot, but they today was the first day that they got a little, if we were at a Spanish bull fight, they got a couple stabs today. And we'll see. They're not at the level where I'm like, oh, it's broken, but they're getting close. I think 175 for NVIDIA. And Charlie, what do you think? 290 for JP?
285. Yeah. 285,
yeah.
I think will be an important break. But yeah, I mean, listen, they're on their way. I'm absolutely convinced they're on their way. But Ben, I wanted to highlight one last name. It's a regional bank name. I shorted it yesterday, called Citizens Financial, CFG. And the reason I shorted this is because we've been seeing a bid in the regionals while the money centers have been selling off. We saw that yesterday, and you're seeing it again today. CFG is the only regional bank that has performed well this year, and it was on my buy list from the beginning of the year. I took it off about 2 weeks ago from my buy list. And the reason I took it off is because it has performed well. I mean, it's outperformed the S&P, and most regional banks have underperformed. But also, it's been a play on capital markets. The three things that CFD has leverage to is one is trading. They bought JMP Securities, and they bought some other smaller, capital markets oriented firms. The other and the other is to private equity. They're doing a lot of deal flow with private equity firms. And the third is private wealth management. They bought all the First Republic, wealth managers. They
That's
bought,
right.
and so it is leveraged to the upside, which is why I bought them earlier in the year. But I don't want to be exposed to CFG, and yet it's acting like a regional bank when it should be acting like a money center. So if J.P. Morgan, Bank of America, Citi, and Goldman all roll over, CFG is going to follow when people realize what they're leveraged to. So I shorted that yesterday.
Okay. Kevin, you want to look at that chart real quick, and then we'll go to your stocks?
Citizens? Yeah,
I think. Look at it real quick, and then we'll go to what the stocks you want to talk about.
Yeah, I think I kind of agree with him. Is that I don't see a lot of technical damage, but the last of that might be yet. Here's the EPS report, and again, if your earnings report doesn't make the stock go up, someone doesn't like it. You can't take out the high before the earnings report, and the down volume is picking up. And if the dynamics that Charlie mentioned come to become more visible, then it's going to hit this too. So, yeah, I think you're a little early, maybe. But that means I'd be shorting it when it really broke down the below the 200 today, and that's a ways away. So, you're doing it right with J.P. Morgan, and that's Superman. So, go find some more kryptonite.
All right, what stocks are you interested in that you want to talk about today, buddy?
Well, and this is I love the way this dovetails because we don't really talk a hell of a lot before the show. I just kind of let my eyes do the talking. And going through the charts last night, I was struck by Jeffries. Here's the Liberation Day scare, and then here is I think First Brands was them, right? Or at least they had a piece of one of the bad auto loans. And now people say, okay, there's not that many cockroaches, but it can't close above the 50. It's spending too much time below the 200. The relative strength is awful. And I just got to believe that if JP Morgan's going down, Jeffrey's going down a lot, because I would call them a corporal versus a general. And, to me, it looks like it wants to test the April low here at 34 or so if all those things come to pass.
I'm with you. I actually just put in the order to the broker to short 5,000. I'm on this. I wish I would have done this summer, but Charlie, right? This is one of the pure plays on capital markets, right? Isn't this what like you read through on Jeffries to how the capital markets are doing?
Absolutely, and they've been the prime funder of the junk bond and subprime space, which is where you would expect to see credit stress develop first. So. I think this is the Bear Stearns of our era.
Strong.
Poor Jeffries. My office used to be right next to theirs. I used to go in there a lot.
I've got a lot of good friends there. I don't like saying this, but this is a dispassionate business. So the charts tell me you got to get away from this. I think.
Yeah,
I totally agree. When I look at this. It's just like if I'm shorting J.P. Morgan, I got to be short this. You know what I mean? Like, let's be honest with ourselves here.
Yeah, and I really want to stress that to members. I mean, if you see, J.P. Morgan and NVIDIA stalling like this, Houston, we have a problem. There's going to be
I can't agree more. The two most powerful stocks are now rolling. You start getting bigger when they roll, is my view. You start. I was talking to my buddy Charlie yesterday about pressing, and that's what separates great traders from just, I had a good idea. When something starts working, you get bigger. You average up. You average down when it's working, and it's the hardest thing to do.
You don't let the wildebeest get away. You chomp on its neck.
And
Yep.
Bakes, you made the comment about you like to see it break the 200-day, and I'm very conscious of what you say, and I remember what you say. So I actually did go back and look at how far down is the 200-day from yesterday's close. So for Bank of America, you'd only need another 6.8% drop. For JP Morgan, a 5.8% drop. For Wells Fargo, 5.3% drop. Those are
Yeah.
not out of of possibilities in a market that gets dicey.
Yeah, no,
And
and this brings up a great point because you have more confidence in those levels occurring because you just outlined why the three biggest lines of business are going to be disappointing, and you're going to have a catalyst on December 8th and 9th. So when the fundamentals and the technicals merge, yeah, you want to press, and I think that's where we are.
yeah, and if you do break those 200-day move averages, you'll also be putting in a monthly reversal. So those two technical things are going to get the Bakes, very excited.
Yeah. Okay. I got a couple more. Do we have time? Please.
Yeah,
Yes.
go ahead.
All right. Because Charlie's on. This is Capital One Financial, and here's the break below the 200-day. It's almost like we script the shows. I mean, it's unbelievable. This is Capital One COF. What's in your wallet? Well, this stock shouldn't be in your wallet, in my opinion. Here's the close below the 200-day. Look at the down volume. Look at the feeble rally. Same thing as with everybody yesterday. I'm telling you, it's. I can't tell you how many charts look like this. New intraday high, and then exhaustion, and then Icarus gossamer wings melt. So and this is commercial lending, credit cards, and automobile financing. What could possibly go wrong? And again, I think the April lows are where you see support, and it's going to be very interesting to see what happens on their next earnings report.
I would just add, I published on Wall Street Beats last night a piece on the credit card fundamentals, and you'll see from the monthly trust data that Capital One had the biggest jump in delinquencies from September to October in their master trust credit card data.
There we go.
All right.
This is a hell of a team sport.
Yeah,
Kevin, let's go to the Bitcoin real quick. I sent you that
Hold
chart.
on. Let me. I want to finish with that, but let me show you one thing real quick, and then we'll go to Bitcoin, which I really want to do. But this is for my good friend Berna and others, I think, and maybe Jeff. Not everything is down. In when anything's up in a tape like yesterday, I pay attention. And here's Capri. Okay, that's bullish action. It's a CPRI, Capri Holdings, not Capri Sun, Capri Holdings. And that is a really nice looking chart that looks like it wants to get on its horse after this big base for, since the Tapestry deal fell apart, and it looks like things are turning to the upside. So if you're acting like that in a down tape like yesterday, I'm pretty impressed. Capri Holdings, CPRI, and I can't wait to hear what Berner and Jeff chime in with.
All right, let's talk about Bitcoin since it's clearly like the most topical thing right now. And
Okay.
you follow me on Twitter. I've been pimping the Sailor, who I actually personally like, and he's been nice to me. So I know but I think that this Bitcoin sell-off is an all-timer, right, at this point?
Yeah, I mean, and I think I've got a highlight reel on strategy where, I said something to the effect of, okay, this is acting badly, and it might just be because it's at a premium to Bitcoin, or it might be Bitcoin is rolling over and all these ETFs are sapping the buying demand for strategy, or all three, and it might be all three, and that's coming home to roost. The stock's down 46% since my buy signals kicked up. And I haven't gone through the financials to see, okay, below this level, this tranche of debt is underwater, and they have to kick in. They got margin calls. I'm sure someone smarter than me has done that, but this is a bad place to be.
Anyone who has followed my writings this calendar year, I've been likening this year to the panic of 1907, and I've written extensively about that and posted a lot of those pieces on Wall Street Beats. But the one an analog to what's happened in 1907 to what's happening today is in 1907, Otto and Augustus Hines, along with Charles Morse, tried to corner the market in United Copper Company. And when that effort failed, it was viewed in hindsight as the catalyst to the panic of 1907 in the markets, because there were all sorts of call loans that started collapsing the market. I think October 10th was the key date where Michael Saylor and his buddies, who've been trying to corner the Bitcoin market with their convertible preferred offerings, got into trouble, because that was a date that was a big bloodbath. A lot of the exchanges were taken out. There was a lot of bloodletting that day. And so you had reduced liquidity in the whole cryptocurrency market starting October 10th. And that started to show up in higher repo financing rates and stresses in liquidity in the system. So I think that is what I think is the epicenter of what's emerging. Now, the question is, where does it ripple to? Because that's what happened in 1907. You started with the failure of the ability to corner United Copper Mining, but then it rippled through to other asset classes. So that's what we have to follow now, is the ripple effect.
Yeah, I mean, like, my opinion is that we're in a global deleveraging. You're seeing it all over. The dollar, excuse me, the dollar's had a little bit of move, although the yen's kind of ticked back a little bit today, although the euro's ready to break 115. And if anybody's interested, like, that's my favorite currency short right now, and very large short the euro, short euro stocks. And so we're not seeing like the S&P get smashed. It's really kind of a rotation. So again, this is a little different situation than like the spring, or, one of these things where like the whole market's falling apart. Right now, it's just a rotation from the high flyers to,
Energy and
businesses that have
healthcare.
low valuations, basically. What?
And energy and healthcare. I talked about it on the last show. I mean, oil's at 58, but the stocks are acting. They don't act great, but they act better. And here's the S&P. Same thing, that intraday reversal, and to the point that Charlie made. Close below 650. It's going to be a monthly reversal that you're going to have people talk about. Right, we're right at it right now. 653.02 is the October low.
But I guess what I'd say is, it's interesting because I look at the board right here, and a lot of sectors are up, and of the S&P right now, 80% of stocks are up, but the S&P's flat. So basically the generals and the most leveraged stuff is getting hit, and your XLVs, your XLPs,
Yep.
your the Bush portfolio, basically, right? Bonds, regulated utilities. Let's separate out the IPPs, which have a big beta component, staples, healthcare, and to some extent energy. I know Charlie owns energy. I like energy. I think that I'm not really fully there. I own a little bit, but like, I do think that energy will set up for a bull market in the back half of the decade. And it has a negative correlation to the market just in general. So you're just seeing the stuff that's massively underowned get bid. Now the question is, were those just funding stocks where guys were shorting those to buy all this other stuff, and now they're covering that in getting rid of their longs? We don't know. We'll see. That's something to keep an eye on. But in the meantime, I think that it is a very interesting time. You should come check us out on Wall Street Beats, wallstreetbeats.com. And I am Benjamin Brey. That is Charlie Peabody. That is Kevin Bakes Baker. It was a fun show, fellas. And it's a fun time in markets. So I'm glad to be doing this with you guys.
Amen. Me too.
All right. Take care, guys. We'll be back tomorrow. Or Monday, sorry.
Keep smiling. Have a great weekend. Jen, thank you. Have a great trip.